Monopolies have a single seller, no close substitutes. They're a price maker. They can control prices. No one can enter. And there's a lot of non-price competition, usually through advertising the product. So examples of monopolies include natural gas, electric, water, and they're run by the government because people need those. So the government owns them. And then near monopolies, Intel and Whammo, and then professional sports teams. So monopoly, strong barriers to entry effectively block all potential competition. Factors that keep firms from entering an industry, including economies of scale, legal barriers, patents and licenses, ownership of essential resources, pricing. So monopoly, there's a lot of economies of scale, which means that they can produce more and more, and then the cost goes down, and the monopoly keeps going because of patents. So they have patent protection, and no one else can make their product, or resource ownership. So they have ownership of a certain resource like oil, so they can just keep monopolizing something. And then the government doesn't regulate it. That can allow for monopoly. And then the firm is a single price monopolist, charges the same price for all units of output. And then the crucial difference between a monopolist and seller in a perfect competition lies in the demand side of the market. So the monopolist industry, demand curve is a market demand curve, marginal revenue is less than price. So in this case, this is where the monopoly is. This is usually monopolies are when marginal revenue equals marginal cost. In this case, this is the closest we get. So marginal revenue equals marginal cost in a monopoly, therefore causing maximum profits. Here it is closer than the rest. So marginal revenue does not equal marginal cost, but here we are trying to get as close as possible to them equaling, because none of them equal in the chart. So if you're going to be an accountant, you could figure out when marginal revenue is close to marginal cost and then tell the business to operate at that quantity. So in this case, you would operate at 5 quantity, so sell 5. So like sell 5 for a quantity to maximize profits. You could start a business analyzing accounting statements and figuring out when figure out where firms should operate to maximize profits. The steps for graphically determining profit, maximizing price and economic profit, determine where our marginal revenue equals marginal cost, determine the profit maximizing price by extending a vertical line upward from the output, determine the pure monopolist economic profit by using one of two methods. So just find profit through finding the difference between the price per unit and cost per unit, or doing total revenue minus total cost. So you can do one of those ways. And this is where profit is maximized, where marginal revenue equals marginal cost. So this is profit maximization. So under monopoly, consumer surplus is less. Consumer surplus and producer surplus is less because they don't produce as much as they should in an efficient economy. If we had perfect competition, we would produce exactly what we need. But the problem is in monopoly, we don't produce as much as we should. We produce less. So there's going to be a loss to that, to our economy. And the loss is this triangle. So this triangle right here, is a loss because we produce too little. And this is all we lose. Everyone loses from that. Us, companies, the whole economy. So to get rid of monopolies, there are ways to do this through the anti-combine laws being changed, regulate prices and operations of natural monopolies, and ignore monopolies which are unsustainable in the long run. So it's good to, one of the things that we can do to eliminate monopolies is to create foreign competition. So bringing in companies like Bayer from Germany for chemicals. We can create competition in the chemical industry. Daimler from Germany, we can create competition in the automobile industry. Michelin from France for tires to create competition. Lenovo from China for electronics, and so on. So bringing in foreign competition can allow for us to have better, to eliminate monopolies. And then price discrimination is when everyone gets a different price. So they figure out what everyone's willing to pay for it through a lot of the time through their data. So they use the data from the internet to figure out how much someone values something for, and then they sell it to them for that price. So they create different prices for different people. So they do this through business class airline tickets. Business class gets a higher price for it because they value it more than for economy. So economy, they value it less, so they get a lower price. So that's what they do for price discrimination. This is a way to make the most money. They can do this through collecting online data, but it's very hard to do. They need to have a lot of data on people to do this. And then, so monopoly power, price discrimination can be done through monopoly power. They can control output and price. Market segregation. So segregate buyers in different distinct classes. So business class and economy for airlines. No resale. The original purchaser cannot resell the product or service. So airlines do this. Yeah. High fares for traveling executives. So because they need travel, while low fares for people like us going to Florida, because we don't need to fly, so we're gonna get low fares. And higher rates in the evening and on weekends when demand is strong for theaters and golf courses. So they set prices differently to make more money in different times of day. Then coupons, people that are low income use coupons. People who are high income don't use coupons. International trade, it depends on country. So yeah, big data, like I said, they use online price discrimination through big data. So they collect big data and then they figure out who values something low at a low